Thank you for tuning in to another great video by Destiny. Over the years, Margaret Lomas has answered hundreds of viewer questions about many aspects of property investing. Here's one of them.
Hi Margaret, we bought 1.33 acres of land in a subdivision at the end of last year with the hopes of building a home on it in 2014. Since we bought the land, my husband was in a pretty bad work accident and our plans to build a home have changed. We'd like to put the land up for sale now, but we have questions on the capital gains that we might owe since we've not owned it for a year yet. We paid $35,000 and we're not looking to make a profit on it when we sell. Sean, when you buy any property as an investment, it immediately begins attracting capital gains tax. CGT applies to all property that you own, regardless of whether you intend for it to make a profit for you or whether you think that you might use it at some time in the future for yourself. Your own home or principal place of residence is exempt from capital gains tax, but you can only claim one property at any one time for that exemption. It must also be a property which is your bona fide principal place of residence. The rate of tax is determined by how long you hold the asset for. In the case of property, you get a 50% discount if it's over 12 months, and you pay tax on the whole gain for any asset held less than that. In your case, you purchased this acreage for the purposes of building your own home, but at no time has it been your principal place of residence, and so you may have a CGT liability if you are claiming your principal place of residence exemption elsewhere. It'll be at the full rate. If a contract for sale is signed within 12 months of you signing your own contract, then the CGT will be applicable. However, if, as you say, you don't intend to make a profit, you may instead have a capital loss. This is because your cost base, which is the starting value, is the purchase price plus your cost to buy, and your proceeds figure is the sale price less any cost to sell. In addition, the interest on any loan that you had for this land, plus any costs that you incurred while you held it, like your rates for example, add to the cost base, effectively reducing the difference even further. Now this difference becomes the gain or the loss. If you sell for a similar price to that which you paid, once you account for all the costs I mentioned, you'll be more than likely to have a loss and there won't be any tax. However, there'll be no tax deduction either because the loss can only be carried forward indefinitely to be written off against any future capital gain that you could make from some other investment. Now you need to be sure to get some really good guidance from an accountant around what you can and can't claim prior to even making the sale.
If you think you've learned something from this video and would like to become a better investor, give us a call. For more than 20 years, Margaret Lomas and her company, Destiny, have been helping investors to build substantial property portfolios using safe and successful strategies. Destiny is different because we don't sell property. We're truly your advocates for property investing success. To find out more, call now on 1300 693 378 or visit our website destiny.com.au.